Ever feel that knot in your stomach? It's Sunday night, bills are due, and all that's echoing in your head is, where should I actually put my money? You're bombarded. Stocks, crypto, real estate. Everyone's got a hot tip. But blindly jumping in, that's a recipe for disaster. The real problem? It's not a lack of options. It's a lack of foundation. Most advice throws you into the deep end without teaching you how to swim. Investing shouldn't be a gamble, it should be a strategy aligned with you. Because here's the truth, investing isn't just about chasing high returns. It's about building a life you actually want. It's about aligning your money with your values and your deepest goals. What does money mean to you? Freedom, security, impact? Your answer dictates your path. So, where do we begin? Not with stocks, not with Bitcoin, but with something far more crucial: baseline financial security. Step 1. Calculate your essential monthly expenses. I'm talking rent or mortgage, utilities, groceries, transportation, the bare minimum to survive. Don't estimate. Track it. Use a budgeting app, a spreadsheet, whatever works. Know your number. Next, build a starter emergency fund. Aim for 1 to 3 months of those essential expenses. I know it's not sexy, but this is your financial oxygen mask. Why is this so important? Because life happens. Car repairs, medical bills, job loss. Without that emergency cushion, you're one unexpected expense away from going into debt. And debt cripples your investment potential. Imagine this: the market dips. Everyone's panicking, but you're sleeping soundly because you have cash on hand. You're not forced to sell low, you're in control. That's the power of financial security. Now, let's dig deeper. Step 2. Define your why. What are your core values? What are your long-term goals? Do you dream of early retirement? Traveling the world? Starting a business? Funding your children's education? Your values shape your investment choices. Are you passionate about sustainability? Consider socially responsible investing. Want to support innovation? Look at growth stocks or venture capital, keeping in mind associated risks. Your why is your compass. It guides you when the market gets rough. It keeps you focused on what truly matters. Because investing without a purpose is like sailing without a destination. You'll just drift aimlessly, vulnerable to every passing storm. All right, let's recap. We've established your financial bedrock, knowing your essential expenses and building a starter emergency fund. We've also identified your why, your values, and long-term goals. Now, we confront the enemies of wealth: debt and unforeseen emergencies. Step 3. Eliminate high-interest debt. I'm talking credit cards, personal loans, anything with an interest rate that's bleeding you dry. These are financial vampires, sucking away your potential returns. Prioritize the highest interest rates first. This is often called the debt avalanche method. Focus every extra dollar on obliterating that one debt, then move on to the next highest. There's also the debt snowball method, where you tackle the smallest debts first for quick wins. It's psychologically rewarding, but mathematically, the avalanche saves you more money. Debt isn't just a financial burden, it's a mental one. Studies show that high debt levels correlate with increased stress and anxiety. That stress can cloud your judgment, leading to poor investment decisions. You might be tempted to take on more risk to try and quickly escape debt, which can backfire. Now, step 4. Build a robust emergency fund. That starter fund we talked about? That was just a taste. Now we're aiming for 3 to 6 months of living expenses, or even more if you have an unstable income or high-risk job. Where should you keep this? Not under your mattress. A high-yield savings account or a money market account is ideal. Look for accounts insured by the FDIC or NCUA. Think of your emergency fund as your financial shield. It protects you from unexpected job loss, medical emergencies, or major home repairs. According to a report by the Federal Reserve, nearly 37% of Americans would struggle to cover an unexpected $400 expense. Don't be one of them. But it's more than just protection. It's opportunity. Imagine a great investment opportunity comes along, a stock dips, A business is for sale. With a fully funded emergency fund, you have the flexibility to seize that opportunity without jeopardizing your financial security. Let's be honest, managing debt and building an emergency fund isn't glamorous. It's not as exciting as picking stocks or investing in crypto, but it is absolutely crucial. It's the unsexy foundation upon which all successful investing is built. All right, let's recap the prior steps. Financial security first, with expenses covered and that starter emergency fund in place. Your why is clear. Values and long-term goals defined. You've faced down high-interest debt and built a robust emergency fund. Now we start investing for growth. Step 5. Contribute to employer-sponsored retirement plans, especially if there's a match. 401ks, 403bs, these are golden opportunities. Why prioritize the match? It's literally free money. If your employer matches 50% of your contributions up to 6% of your salary, that's a guaranteed 50% return on that portion of your investment. Maximize this first. Contribution strategies, at a minimum, contribute enough to get the full employer match. Then consider increasing your contributions gradually over time, aiming to max out the annual limit if possible. Step 6. Open a Roth IRA or a traditional IRA if that better suits your circumstances. A Roth IRA offers tax-free growth and withdrawals in retirement. Pay taxes now, enjoy tax-free income later. Contribution limits? These change annually, so check the IRS website for the current year's limit. Eligibility? There are income limitations for contributing to a Roth IRA, so research those as well. Investment options within an IRA? Index funds, ETFs, stocks, bonds, a wide range. Early-stage investment strategy. Broad market index funds or ETFs are your friend. Diversification is key, especially when starting. Low-cost index funds, spread your investment across hundreds or even thousands of companies. Behavioral finance tip, avoid chasing hot stocks or trying to time the market. It's a losing game for most people. Focus on long-term consistent investing. Historically, the average annual return of the S&P 500 has been around 10%, but remember, past performance doesn't guarantee future results. All right, a quick review of the prior investment steps. You've secured financial stability, defined your why, tackled high-interest debt, fortified your emergency fund, and capitalized on employer-sponsored retirement plans, especially snatching that free money match. Roth IRA opened? Check. Early investments diversified into broad market index funds? Excellent. Step 7. Maximize those retirement accounts. Pump up those contributions to your 401k and Roth IRA, aiming for the maximum allowed each year. The tax advantages are substantial. You are either deferring taxes now or avoiding them later. As of recent years, the 401k contribution limit is $23,500, with a $7,500 catch-up contribution for those 50 and older. Roth IRA? $7,000 with a $1,000 catch-up if you're 50 plus. Remember to adjust your asset allocation based on your risk tolerance and how far you are from retirement. More stocks when you are younger, gradually shifting towards bonds as you approach retirement to reduce volatility. Step 8. The taxable brokerage account. Here's where things get interesting. Once you have maxed out your tax-advantaged accounts, this is where you can invest without those tax benefits, but also without the contribution limits. Invest in a well-diversified portfolio. Think stocks, bonds, and other assets aligned with your goals. Tax implications? Crucial to understand. Capital gains taxes apply when you sell assets for a profit. Dividends are also taxable. Develop tax loss harvesting strategies. Selling losing investments to offset capital gains can significantly reduce your tax burden. It's not about avoiding taxes, it's about being smart about them. Time for a word of caution. Advanced investment strategies like real estate and alternative investments can offer higher potential returns, but they also come with significantly higher risks. Real estate requires substantial capital and management. Alternative investments are often illiquid and difficult to value. Approach these with extreme caution and only after thorough research. A 2024 study by Cliffwater found that private equity significantly lagged the public market in recent years, illustrating that even sophisticated strategies don't always win. So, instead of chasing complex strategies to beat the market, focus on keeping your long-term plan on track. Step 9. Rebalance. Think of your portfolio like a garden. You can't just plant it and forget it. Rebalancing means selling some assets and buying others to maintain your target allocation. If stocks have surged, you might trim some gains and reinvest in bonds to stay aligned with your risk profile. Annually or semi-annually is often sufficient. Step 10. Never stop learning. The financial landscape is constantly evolving. Read, research, adapt. Follow reputable financial experts. A 2023 Gallup poll indicated that only 37% of Americans have a long-term financial plan. Don't be a statistic. Adapt as life changes. Crucially, consider professional guidance. A certified financial planner can create a comprehensive roadmap tailored to your unique situation. Investing is a marathon, not a sprint. Patience, discipline, and continuous learning are your greatest assets. It's about aligning your money with your values. Now, take action. Start small, stay consistent, and build the future you deserve.